The United States has now spent more money fighting the economic effects of the coronavirus than it did fighting both world wars combined, adjusted for inflation. Unsurprisingly, this has led to some economic distortions that could have long-term repercussions. In fact, there is something very alarming happening right now with the world economy. One of the key issues of the next 20 years may very well be this one. So, what exactly is the problem? Welcome to the Financial Flow. Please like and subscribe to our channel and turn on notifications to stay up on our latest videos. In essence, the Federal Reserve Bank of the United States and a number of other central banks from around the world are being compelled to take back the entire amount of money they have been busy printing to support stimulus efforts. Reverse repos from the Fed recently reached a record high of $1 trillion, effectively undoing over 8 months of quantitative easing efforts. Everyone is at least generally aware of what is happening. If you do comprehend it and believe that eliminating cash from circulation is a good idea, you might be correct about the way things stand right now. But if that were the case, this would only serve as a temporary fix, or in the worst case scenario, act as a crutch that makes the issue worse in the long run. So what are these Fed reverse repos that are causing so much concern among economists? Why do some claim that doing this might reduce the risk of hyperinflation? Why might this phenomenon eventually worsen everything, including inflation? Repos or repurchase agreements are simply a financial instrument that is a secured, very short-term loan. Now, the company calls their bank and decides to sell this brand new piece of equipment to the bank itself rather than delaying employee paychecks or going through the drawn-out process of applying for a business loan. The bank was in an extremely safe position, and the company was able to access the cash flow it needed to pay its employees for a very low effective interest rate. These financial instruments get their name from this sale and the subsequent agreement to repurchase. Today, regular banks and central banks carry out daily operations that are remarkably similar. A regular bank may enter into a repurchase agreement with the Federal Reserve if it is running low on cash. They typically do this by exchanging cash at a very low interest rate for very low risk assets like treasury bills. The cash rate is another name for this. The purpose of this is to prevent banks from having to stop lending money if a large number of people decide to withdraw their money on a particular day. It's bad news if there isn't enough money on hand to honor withdrawals because that would prompt a bank run. As a result, both the Fed and deposit-taking institutions take this responsibility very seriously. Reverse repos, which are exactly what their name implies, are the source of the current issue. Through these reverse repos, your bank can keep money with the Fed for safekeeping in the same way that you can deposit money into your bank account for that purpose. In this type of agreement, the bank will buy assets from the Fed in exchange for cash, with the Fed agreeing to buy the bills back the following day for a marginally higher price. You have probably heard the term overnight cash rate, because both Fed repo, in which private banks sell their assets and receive cash, and reverse repo, in which the Federal Reserve sells assets and receives cash, occur on one-day terms. The premium that the Federal Reserve Bank receives, or gives, on these repurchase agreements is what changes when interest rates do. Economic uncertainty was greatly exacerbated by the coronavirus pandemic. Businesses were shut down, people were without jobs, and businesses were unable to function. The Federal Reserve reduced its overnight cash rates from a 2.50% effective annual rate to a 0.05% annual rate in response to this economic downturn. This is what they did following the 2008 financial crisis and pretty much every other economic downturn over the previous 5 decades, because banks could stock up on cash at low rates and pass this along to customers. It was hoped that banks would lend more money as a result. Additionally, because banks wouldn't receive much money for doing so, as we saw earlier, it served as a disincentive for them to park large sums of money with the Fed. In any case, the ultimate goal of this is to increase the amount of money flowing into the economy for consumers to spend, counteracting the effects of the recession itself. Essentially, this is countercyclical monetary policy. The issue is that it's not really functioning at the moment. You see, a lot of money was recently raised to pay for the various stimulus initiatives that were used to combat the coronavirus. With nice fresh, new piles of new money, everything from the Paycheck Protection Program, PPP, to those $1,400 checks was paid for. Despite the imagery, very little of that money was actually kept in physical form. Instead, it was stored digitally in people's bank accounts. Banks would typically take this money and lend it out or invest it to generate profits, but they currently have some restrictions on how they can do that. Business loans are currently hit or miss, so they don't really want to write residential mortgages with 30-year terms and record low interest rates. Even the use of credit cards is rapidly decreasing. Additionally, a lot of banks are reluctant to make stock market investments at this time due to market volatility. As a result, banks are holding large sums of money on behalf of a country's businesses and citizens who have benefited from the biggest stimulus program in history. Even though this isn't great for financial institutions' quarterly profits, it doesn't sound all that bad. First off, it demonstrates the extremely low level of participants in the economy's overall confidence. Everyone is storing up as much as they can, from common people to the biggest banks in the nation, just in case. Currently, the higher savings rate is less of a problem than a warning sign that people may not be entirely confident in the future at this time. The fact that there is so much money floating around potentially limits some of the ability to control the economy. The velocity of money, as it is known among economists, is a factor in all of this. Many people claim that because of the velocity of money was at an all-time low, there was little risk of sustained inflation. Are the economists thus in error? The velocity of money is a measurement of how quickly money is transferred, typically done on a quarterly basis. But even more concerning is the fact that, as we already saw, people are saving money either due to fear, lack of opportunity, or inability to go outside and spend a lot. People are simply sitting on their cash hoards. Of course, this won't continue indefinitely, although the amount of money won't decline. Eventually, people will spend it. In order for the velocity of money to return to a more normal level, let's say from one average transaction per quarter to 1.5 average transactions per quarter, either real GDP would need to increase by 50%, the money supply would need to decrease by 33%, or inflation would need to rise by 50%. What do you consider to be the most likely scenario? The economy is currently being pumped full of cold money, but once things heat up again and those money particles start moving around, economists are concerned that we may face a problem that is beyond our capacity to handle. Nobody, not even those on the internet or economists, and especially not those economists on the internet, can accurately predict the future. Hopefully, a combination of all three of these elements will be present. It will develop very gradually. While 50% inflation over 20 years is perfectly acceptable, 50% inflation over 2 years is disastrous. Thanks for watching. Don't forget to leave a like and subscribe to our channel for more content like this. Have a good one.